Okay, hi everyone, welcome back. And in this update, we are going to check out QNT's price chart and see what is happening in the short term. And I'm going to overall tell you why, in my view, we are actually very close to the end of our move down. And most likely, pumping time is just right around the corner. But before we get into all that, let me talk to you about this very important tweet from QNT's account about Overledger Fusion, which, in case that you are a new viewer, you should know this is basically their institutional layer 2.5, and I'll explain what is the problem that they are claiming that going to solve, why institutions might actually care, and how QNT could benefit from all this if this is actually going to work big time. So, are you ready? Let's dive in and see what is going on. And I think first things first, we have to talk about the potential problems that QNT and Overledger Fusion is at least claiming that they are going to solve. And the first problem, I think you all know it because we have been talking about it in this channel basically non-stop in the last couple of months. It is called fragmentation. You see, at the moment, tokenized assets live on a bunch of different chains. And that, well, unfortunately, splinters liquidity and creates operational pain. And if you are, for example, a bank or let's say a custodian, you have multiple ledgers to reconcile, different bridge flows, and rolling custody logic that does not simply match up. And that means number one, more manual checks. Number two, longer settlement path. And number three, much more important than all those, basically worse pricing because markets are thin and scattered. Second important problem that QNT is basically claiming that they are going to solve comes down to the fact that institutions actually need a different environment than retail DeFi. You see, major banks and institutions basically need an issuance flow that looks like traditional finance, meaning you got legal wrappers, upgradability, controlled governance, audit trails, and KYC/AML gates, all that good stuff. And they also at the same time want the ability to trade and settle quickly, but with those enterprise controls absolutely intact. Now, here's the thing. Public L1s give liquidity and composability, but they simply do not, at least natively, give the permissioning and governance institutions actually require. So in this scenario, Overledger Fusion is pitched as the layer that is able to sit between these needs, meaning an institutional friendly zone that still connects to the public liquidity. Now, the final problem comes down to the gap, to the classic gap actually, between privacy and compliance versus public liquidity, because permission systems are great for privacy and control, and on the other hand though, public chains are good for liquidity, and the real challenge in here is making those two worlds interoperable without creating more and more risk. And if you tokenize, for example, an asset on a permission ledger, how do you tap public stablecoin, automated market makers, or liquidity pools without opening attack surfaces or breaking compliance? Well, this is exactly where Overledger Fusion comes in clutch by trying to be the unified surface where those flows can happen very much safely. Now, at this point, you might be a bit confused and you might ask, well, okay, why do I think Overledger is such a huge deal? In my opinion, there are two very important reasons for that, and the first one has to be the network effect, because if big institutions start issuing and settling on Overledger Fusion, then okay, you're gonna have a self-reconciling loop, meaning more issuance is going to attract more and more traders and market makers, which will again attract more and more issuers. And if QNT is the economic or let's say governance anchor inside the fusion, then okay, demand for QNT token is going to rise big time because it is going to become the plumbing token for fees, staking, or even access control. Meaning what? Well, over the mid to long term, I think the price is going to appreciate big time since we are having fixed total supply of, I think it was about 14.8 million tokens. Now, the second reason has to come down to enterprise positioning, because this is, in my view at least, a much more clear message to banks and custodians than, for example, we are going to connect blockchains, simple as that. Now, Fusion in here is a product they can map to existing workflows, including, for example, issuance, upgrades, trading, maybe settlements, all that good stuff with compliance primitives already baked in. And that, my friends, is definitely a useful sales pitch when you are talking to compliance teams and CIOs, not just some developer communities. Now, let's look at this from institutions' point of view, and you might ask, well, okay, why do they care? For three reasons, in my opinion. Number one is single operational surfaces. You see, with the help of the layer 2.5, as an institution, you basically have one API, one settlement model, one source of truth for issuance and lifestyle events, and that, my friends, cuts reconciliation work and reduces mismatches between internal ledgers and public records big time. So basically, with Overledger Fusion, you are going to have a whole lot less trouble. Reason number two is liquidity aggression, because assets moved into a unified layer can be routed to multiple liquidity pools without repeated wrapping, and that reduces fragmentation costs and improves price discovery big time. And the final reason, in my view, definitely comes down to control programmability, because let's be honest, institutions would absolutely love to keep governance knobs, including upgradable contracts, whitelist, legal metadata, so on and so forth, while being able to access external liquidity rails, like for example USDC or other L1 assets when needed, and Fusion is definitely providing that to them. So that's basically the core idea of the layer 2.5. It is trying to remove friction between regulated issuance and open liquidity while keeping institutions comfortable with control, compliance, and also auditability. Now, at this point, you might say, well, okay, this is all just a simple theory and it doesn't really worth a whole lot. Well, you know what? Fair enough. Let's walk through now a concrete example so this isn't going to be just a simple theory. Let's picture a large custodian bank that runs cash and short-term credit products for corporate and institutional clients. They have a real headache in here, which is settlement being absolutely slow. Reconciliation is going to be a nightmare for them. Capital is going to sit idle for them during intraday windows, and tokenized assets live across different chains, so liquidity is definitely scattered in this scenario. Now, all of a sudden, we are going to have Overledger Fusion, and in this case, that bank decides to issue tokenized commercial paper directly on an institutional layer 2.5 network, and issuance, life scale events, and secondary trading all live in this scenario on that layer 2.5. Basically, in this scenario, the bank still controls custody with its HSM backed keys, but transaction processing runs on trusted nodes that meet jurisdictional and also compliance requirements. Secondary trades either settle instantly inside the layer 2.5, or they automatically bridge to external layer 1 assets, like for example USDC, when they are going to need more and more liquidity. Now, the main question is, well, okay, what's actually in it for banks and institutions to use Overledger Fusion? In my view, 5 very, very important things. Number one, liquidity in this scenario gets free, because for a desk holding billions and billions of dollars in short-term paper, moving from T+1 or maybe T+2 to near instant settlement reduces intraday funding needs by a few percentages. And you might say, well, okay, a few percent is not really that much. Well, not really. A few percent in this scenario translates to literally tens of millions of dollars unlocked for trading or maybe lending, which is huge. Number two, Overledger Fusion will provide them lower operational costs. Why? Because manual reconciliation and exception processing in this scenario falls sharply with the help of the layer 2.5. And I think I saw a report that said a realistic estimate is about between 30 to even potentially in some cases 50% lower operational costs for that product line within a year, which is awesome. And the final reason has to be faster product, and let me break this down with an example. Let's say a bank wants to offer a new type of short-term investments, and in this case instead of spending months on paperwork and tech setup, they just tweak a few settings in the system, making sure that the buyers are verified, and boom, all of a sudden, it is live in just simple a few weeks. And that, my friends, is a huge win for institutions and major banks. Now, on the other hand, the question is, well, okay, what if some other company is going to beat over Ledger Fusion to the race and they are going to be successful? In that case, well, okay, the Fusion is absolutely going to be useless. So I guess the question is, why is it that the layer 2.5 specifically is probably going to be the right fit? I got two very important reasons for it. Number one is compliance first primitives. You see, Fusion Designs lets institutions pick trusted nodes, enforce jurisdictional controls, and bake legal metadata into on-chain records, and that is what regulators and compliance teams exactly want to the T. Reason number two is multi-ledger settlement, because a real institutional fabric needs to route value across multiple L1s, and Fusion, well, it actually enables native routing and near atomic settlements with different chains, so the bank can choose the best liquidity pool at any given moment. So what's the takeaway from all this? And I know we have talked about a lot of technical stuff in today's update, and this might be a bit boring, but trust me, I believe these are actually the things that really matters. So again, what's the conclusion? In my view, Fusion style layer 2.5 is going to give institutions the control and at the same time compliance they require while connecting them to broad liquidity. And if that stack delivers on security, settlement guarantees, and real cost saving in pilots, well, okay, in my view, makes sense to say that adoption is going to shift from isolated proofs to industry standard rails, and when institutions route issuance and also settlements through a unified layer, in this case Fusion, okay, the network effect is going to be absolutely powerful, meaning what? The demand for the native token, in this case, we are talking about QNT, is going to grow big time. And again, it's just supply and demand, since you are having a fixed supply of 14.8 million, and at the same time, demand is going to increase. What will that lead to? Yep, you guessed that right. Huge price appreciation. So in my view, QNT is definitely in the right spot to win the interoperability race, and that, my friends, is exactly why I am so bullish. And I do believe that if we are going to have an alt season by the end of the cycle, QNT is most likely going to participate in that, since in terms of fundamentals and also technical analysis, I'm going to talk about it in a minute, we are basically in a great place. And the question is, well, okay, why shouldn't we participate in an altcoin season? See, in terms of what is going on in technical analysis, and especially in my field of works, Elliott waves, as you can see, the price for the past 4 years has been just compressing more and more, and these types of price action usually leads to absolute massive explosions. So yeah, I'm gonna say we are probably primed for a huge bull run by the end of this cycle. Now, in terms of what might happen in the next, let's say, couple of days to about couple of weeks, you know what? Fair enough, that can be up for debate. But I need you to understand one thing. In my view, no matter what is going to happen in this area in like very short term, one way or the other, we are looking very much bullish, and there is like a very high chance this is from here and not the highest high, and A, B, C, I'm gonna say most likely in form of a running flat structure, which into our C leg, we should not actually take this important low down here about $85. Now, what if we take it? Okay, even in that case, I'm not really going to be that mad, because that's just going to fall into the category of having, as opposed to a running flat, just a simple ABC expanded flat, and the target for that move is going to be probably reaching to about here between 75 to around, let's say, $79, which is a very strong weekly and also daily time frame support. And I want to be very clear, I actually do not believe that we are going to get to here. I don't even think that in QNT we are going to take this low down here about $86, $87. Why? Because having such a move is probably going to require Bitcoin, for example, to reach to about, let's say, the 100K level, which is possible, do not get me wrong. However, based on what I'm seeing, it's not really likely. And I'm going to be honest with you guys, I really have a hard time believing that only in QNT we are going to see a 20% drop, while other altcoins are going to do nothing. Maybe even some of them are going to go up. I just don't believe that is the case. Or at least, let me just say this. I don't really see any conditions supporting this scenario. In my view, this is a very slow and choppy move down in QNT in form of a correction structure. And sure, in this area, we may have maybe another move on the downside in order to take this low, but I really don't think that we are going to go a whole lot lower, as long as you probably know what I'm about to say, right? I'm not really seeing a break of that divergence line that we talked about before. You see, in H4 time frame, as you can see, we are having a low, the other ones are lower lows. However, in MACD, what do you have? This is a low, the other ones are higher lows. So this is a beautiful looking bullish divergence, which by itself is a fantastic sign, suggesting, you know what, in QNT, bears are running out of steam, and indeed we are going to have a massive bounce back. Now, on the other hand, if in this area we do end up getting a break of the divergence line, okay, that might be a bit of a different story. And at that point, count on, I'm going to say probably at least a 10% move on the downside in order to reach to about the $90 to $91 level. As long as we are not doing that, I do believe we should consider the end of our correction structure, the whole ABC running flat in QNT, to be right around the current area. And what do you think is next? I'm going to say a huge bull run, because in my view, this is 5 wave up into 1. This is correction for wave 2. And what's next? You know the answer. We're going to have a massive move on the upside into wave 3, 4, 5, which, by the way, just in this phase, I'm expecting QNT to set an all-time high and take the highest high, which I think it was somewhere around the $450 area. So overall, we are looking optimistic. Do not let anybody tell you otherwise. It's just a matter of what might happen in the next, let's say, week or two, and even that's not necessarily bearish. And I hope I explained everything well and you understood what is going on in Quant. Anyway, if you found any value in my content, I would really appreciate if you like this video and consider subscribing to my channel and follow me on Twitter. And if you want more, maybe you want a complete analysis for your own specific crypto, or maybe you want to learn some decent TA in order to be able to make good money in the markets, you can become a member and ask me anything you want. And until the next update, I hope you have a wonderful time with your family and loved ones. Goodbye.